IAS 12 Income Taxes establishes the accounting principles for recognizing, measuring, and disclosing current and deferred tax within financial statements. Taxation significantly affects profitability, cash flows, and financial position, making accurate tax accounting essential for transparent financial reporting. The standard aims to ensure that tax consequences of transactions are recognized consistently with the underlying accounting events. IAS 12 addresses both current tax, which relates to taxes payable or recoverable for the current and prior periods, and deferred tax, which arises from temporary differences between accounting values and tax bases. Within the DIP-IFR syllabus, tax accounting is important because it requires technical understanding, careful judgment, and the ability to reconcile accounting profits with taxable profits under applicable tax regulations. Current tax liabilities and assets are recognized based on taxable profit calculated under tax legislation applicable within the reporting jurisdiction. Current tax liabilities represent amounts payable to tax authorities, while current tax assets arise when tax payments exceed obligations or losses can be recovered from prior periods. IAS 12 requires current tax to be measured using enacted or substantively enacted tax rates expected to apply when liabilities are settled or assets recovered. Current tax expense is generally recognized within profit or loss unless it relates to items recognized directly in equity or other comprehensive income. Accurate accounting for current tax ensures that financial statements reflect present tax obligations faithfully and allows users to assess an entity's short-term liquidity and tax compliance position effectively. Sales taxes represent indirect taxes imposed on the sale of goods and services, such as value-added tax, VAT, or goods and services tax, GST. Under IFRS accounting standards, sales taxes collected on behalf of governments are generally excluded from revenue because entities act merely as intermediaries collecting taxes from customers. Input sales taxes paid on purchases may often be recoverable from tax authorities and are therefore recognized separately as receivables rather than expenses. Only non-recoverable sales taxes form part of asset costs or expenses. Understanding sales tax principles is important because improper treatment can distort revenue figures, expenses, inventory costs, and profitability. Correct accounting ensures transparency regarding the entity's actual economic performance and obligations arising from indirect taxation systems. Deferred tax accounting is based on the temporary difference approach, which recognizes future tax consequences arising from differences between carrying amounts of assets and liabilities in financial statements and their corresponding tax bases. Temporary differences arise because accounting standards and tax laws often recognize income and expenses in different periods. Taxable temporary differences create deferred tax liabilities because they result in taxable amounts in future periods, while deductible temporary differences create deferred tax assets because they reduce future taxable profits. Deferred tax ensures that financial statements reflect not only current tax effects but also future tax consequences associated with transactions already recognized. This approach improves matching between accounting income and related tax effects across reporting periods. Taxable and deductible temporary differences significantly influence accounting and taxable profits. Taxable temporary differences commonly arise from accelerated tax depreciation, revaluation gains, or revenue recognized earlier for accounting purposes than for tax purposes. These differences result in deferred tax liabilities because future taxable profits will increase when temporary differences reverse. Deductible temporary differences may arise from provisions, impairment losses, or expenses recognized earlier in accounting records than for tax purposes, resulting in deferred tax assets. Deferred tax assets are recognized only when future taxable profits are probable, ensuring prudence and preventing recognition of uncertain tax benefits. Understanding these temporary differences is essential because they directly affect financial position, tax expense, and long-term profitability analysis. IAS 12 requires deferred tax liabilities to be recognized for most taxable temporary differences, while deferred tax assets are recognized only when future economic benefits through taxable profits are probable. Deferred tax is measured using enacted or substantively enacted tax rates expected to apply when temporary differences reverse. Deferred tax assets and liabilities are generally classified as non-current items within the statement of financial position. Changes in deferred tax balances are recognized within profit or loss unless related to items recognized directly in equity or other comprehensive income. Proper accounting for deferred tax requires careful identification of temporary differences, accurate measurement, and continuous reassessment of recoverability. These requirements improve transparency and provide users with insight into future tax consequences embedded within financial statements. Overall, IAS 12 provides a comprehensive framework for accounting for current and deferred taxation in international financial reporting. By recognizing both present and future tax consequences of transactions, the standard enhances transparency, comparability, and faithful representation of financial information. Accurate tax accounting ensures that financial statements reflect realistic obligations, recoverable benefits, and timing differences between accounting and tax treatments. Deferred tax accounting is particularly important because it links financial reporting with future economic effects arising from temporary differences. For DIP-IFR candidates, understanding IAS 12 is essential because taxation affects profitability, investment decisions, cash flow analysis, and corporate financial planning. Proper application of tax accounting principles strengthens the reliability and usefulness of financial statements for investors, regulators, and other stakeholders.